Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, January 2nd, 5:15 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. First video of the year. Let's get right into it. Market state, we're in a short-term pullback. Check the trend gauge over here. Mixture of good news and bad news. Lower time frames, or the quicker time frames, if you want to look at it that way, things a little bit worse. But long term, all the moving averages in the long term trend of the major indexes is above the 200-day moving average. Market never gets into serious trouble unless we break that level. Leaders holding up, we've got them flagged neutral, holding up better than the overall indexes as of recently, despite pulling back. They're just pulling back into, in a lot of cases, the 8-day or the 21-day moving averages. Some broke down a little bit more and are down to the 50-day moving average. We also saw some recent leaders. When I say recent, I mean the early leaders that had been pulling back, making a bit of a bounce today. So maybe the selling on those got done at the end of the prior year, and money coming into them, particularly data center names like VRT and VST, is what I'm referring to today. So neutral on leaders. I'm going to slide this red arrow a little bit over toward the middle as leaders did outperform today. As far as the short-term indexes go, short-term, all of them below the 21-day moving average. We really back off the gas when things break our short-term 21-day moving average. We back off a little bit more if we get below the 50-day moving average, and we've got that at neutral. The NASDAQ 100 was holding up above the 50-day moving average. It undercut and closed basically right on it today. A little bit of strength into the close that offset the early weakness after a gap up. So leaning more towards, we need to get the S&P back above the 50-day moving average, but we're struggling at that level as well. So mixed bag here, some good, some bad, and certainly some ugly against the 21-day moving average from an index standpoint. But what happened today? Well, you've been listening to our videos, you know that the Santa Claus rally kicked off great on day one, but days 2 through 5 were anything but jolly. We've seen harsh sell-off, came into today through 5 days of this rally. Why are we putting so much emphasis on this? Because historically, it really does have a correlation with what happens during the year, what happens during the Santa Claus rally. There's actually a trifecta that we monitor. It's this Santa Claus rally, which is the last 5 trading days of the prior year, the first two of the current year. Watch me change the year all of a sudden. The first two of the current year. The next one is the first 5 days in January, and then the full month of January. And if the correlation wasn't so high for what happens throughout the year, we wouldn't pay as much attention to it. But from a seasonality standpoint, 83% of the time, the Santa Claus rally finishes positive by an average of 1.3%, but we're certainly not seeing that this year. We're now down 1.77% after the first 6 days. So really, we would need a massive follow-through day to the upside tomorrow to even get positive for this 7 session period. Like I said, growth leaders acting okay, but it's the rest of the market not necessarily participating, and now the Qs threatening at the 50-day moving average doesn't help things as well. Tesla missed deliveries today. That was one of the reasons why the Qs were so weak. But here are the numbers. Volatile session, but growth leaders act well. We gapped up by 0.5%, sold off, rallied, sold off, rallied, sold off, all over the place today. Slower, things chilled a little bit for the last 2 hours as we trended higher, coming off the lows. And leading stocks did fine during this session, even when the market was selling off. There, were quite a few green leaders. We ended up the day on average of up 0.75% on the 21-21 list that we're working off of, 13 up, two neutral, six down. The big eight, four positive, four negative. Tesla, as I said, the drag down 6%. So that brought them down an average of 0.52%. The RG8s, our eight growth ETF composite, up an average of 0.33. That's a good sign there. The S&P, as I mentioned, closing well off the lows, but also well off the highs, about 40% of the range, down 0.2%, equal weight, about the same there, and mixed or red for the rest of the indexes. Global 60/40 down a fraction. GROTECTION on the back of the leaders that we are holding up a third of a percent, 0.3% on the day. Let's get into some details, and we'll start off with first, let's take a look here at this stochastic, and it's pretty consistent for the RG8 and the major indexes, all pointing down and either in oversold or approaching oversold. The NASDAQ 100 is the only other one that hasn't quite hit deep into oversold territory yet, but that's because the Magnificent Seven type names were holding up the S&P and the NASDAQ 100 until this Santa Claus rally kicked in, and they've been lagging since then. Uh, the weakness in the equal weight S&P and mid caps and small caps and the Dow, we've been detailing that on all of our videos for weeks. So turn the stochastics off so we can look at this a little bit better. So you can see we've got three closes now below the 50-day moving average, 21-day moving average pointing down. Still have a mild upward slope on the 50-day of the S&P. This 58.50 to 58.78 level, which was resistance over here on the way up in October, acted as support in early November, acted as support 2 weeks ago. It's acting as support again. We pierced 58.50. You can actually take that range down to about 58.30 now. But what we really want to see is the S&P hold this level right here, the lows of late 2 weeks ago and today. And that's about 58.30-ish. That's where we bounced each of those two times. And bulls certainly want to see us get back above this 50-day moving average. So that's the S&P. Let's go to the NASDAQ 100. So again, off the lows, just a hair below the 50-day moving average, and relative weakness over the last 2 weeks. As I said, this carried the indexes into really into this is the Fed announcement where the reaction was extremely negative. We tried to rally a bit off of there, but still relative weakness now for the last 2+ weeks on the NASDAQ 100, and that's going over to the major indexes. There are the S&P as well. I mean, RSP, equal weight. We're holding the lows similar to what I showed on the market cap weighted, but look at how far this is below the 21-day and the 50-day moving average. We're right around the 30-week moving average on that. In fact, let's bring up the weekly chart here. That's the purple line. Red line is the 10-week. Green line is the 20-week. Purple line is the 30-week. And the 40-week or 200-day moving average is the black line. That's where the RSP sits. That's where the mid caps sit, right about there. That's where the Russell 2000 sits, and it's bouncing at that 30-week moving average or the 150-day. Remember, that's a key level that Stan Weinstein did his stage analysis off of. He's since said that things move quite a bit quicker, but we do keep an eye on the 20 and the 30-week and the 40-week as we start to break down when we reduce our exposure, when we start breaking, of course, below the 21-day and the 50-day. Finally, let's go to the Dow Jones Industrial Average. That hasn't quite reached the 30-week yet. We'll go back to the dailies. You can see clearly below the 50-day and the 21-day, and the 21-day moving average breaking below the 50-day, not only for the Dow, but that's also for the mid caps, and that's also for the Russell 2000. So lots of work to do here. This 2200 level is holding up small caps for now. Let's go now to some inter-asset correlation, and we'll start with the VIX. The VIX was up 3.3% today. above that 16 level that we want to see it. So a little bit of a negative there, but below the 20 level. Now, here's the problem. We've been talking about the strength in the dollar, and it broke out today. Um, see, move up here with a flag, another move up here with a flag, and we broke out of that second flag today. Let's look at a weekly chart of the dollar, and you got to go all the way back to late 2022 before the dollar was at higher levels. Uh, Not good. You can see how strong it's been on a weekly basis for the last couple of months, and this is plain and simple a headwind for stocks. A strong dollar, not good for stocks. Let's move on. Let's go to gold now. It's been weak. It rallied today into the declining 50-day moving average. Silver, week below the 200-day moving average. That looks terrible. GDX gold stocks had a nice day, up 4% into the declining 21-day moving average. Bitcoin a little bit volatile today, but closed above the 8 and the 21-day moving average. So good stuff there. Want to see it hold today's lows. We're looking for a possible add to our existing position on this. On to bonds. Broad bond index basically flat today. TLT, the long bond, positive. So positive bonds means negative on yield. So the 30-year yield pulled back a little bit. This is showing higher, but that is not correct. TNX, uh, TNX, the 10-year, slightly up, also showing slightly up. Remember, these close at 3 o'clock, and sometimes there's activity that happens between 3 and 4 that isn't reflected on these charts because this is just the actual bond trade on the yields, not the price of the ETF that tracks it. All right, let's flip to the tail of the tape now. Short-term pullback is our market state, as we mentioned. Not a lot of good stuff going on here on the stochastic. The best thing on the stochastics for the various secondary indicators that we monitor, the best thing we can say is that we're oversold and looking for a bounce. Percent of stocks versus the 5-day down as well. Green arrow because it's a contra indicator. VIX, we talked about fear and greed at 26. So more sentiment data came out, and this is actually contrarian bullish. Bulls and bears are basically about the same. Bulls have dropped in the AAII. This is more retail investors. Bulls and bears, bulls have dropped for 2 straight weeks and about equal between bulls and bears. And the NAAIM, this had been outperforming retail. This is investment managers, but it also dropped 16. Good to see that it got up near the 90s and 100, and that's not sustainable when you see investment managers fully invested because there's nothing left to buy if you've got all your money in. So then what normally you see is price comes back, start getting hit. We take money off the table. They start taking money off the table, and you wait for it to reset. So good indicator to keep an eye on. We're operating under the bear case right now with us being below the 21-day moving average. As I said, Santa Claus rally now, no rally at all, down 1.77% with one session remaining. The keys today, we want to keep an eye on the S&P against the 50-day and this 5850 support level. We're below the 50-day, continue to be, but undercut and reclaimed 5850 as we closed at 5869-ish. NASDAQ 100 below the 21-day, but right on the 50-day. Need to see that hold. The day count, 4 days down, 4 days below the 21-day moving average and the 8-day moving average. Expectations neutral to negative until we get back above the 21 on the S&P and the NASDAQ 100. Our expectations still remaining mildly positive on our growth leaders as the stops just aren't getting taken out. They're bouncing where they need to, in most cases, at the 8 or the 21-day moving average, as I mentioned. One concern is the average true range of the S&P is now poked above 1, and it'll be about a 2% range today. That'll go up even more. That's a bit of a secondary indicator, red flag. But again, price and volume are the major indicators that we traffic in. But a lot of the secondaries are piling up negative, and you can see that's resulting in pressure on the overall indexes. Strong sectors, semiconductors, biotech, oils, XLC, that's communication, XLU is utilities. To the downside, banks, real estate, and home builders. Only trade today was Tesla reported their delivery numbers and they disappointed. It gapped down, no strength at all today. So we took our took our gain as it broke below the 21 day. We took our gain on that final piece. Our adjusted beta 1.18 and our balance at risk approximately 3.15% to the downside. Bottom line, volatile session, but leaders act well. US dollar breaks out. Volatile session, red. Don't like volatility. Leaders act well, that's in green. US dollar breaking out, that's in red. Don't like that either. The keys for tomorrow, the S&P 500 against that 50-day and 5850 level. NASDAQ 100 against the overhead resistance of the 21-day and sitting right on the 50-day. That needs to hold. Let's get into some individual names now. I mentioned VST and VRT. Let's take a look at those. And those led uh, early in the rally, which really started last November. Some good action here. They've been forming a base lately, but during a typical low volume period, this had average volume today. This is VST. This is the utility that has a big data center component, up 8.6%, clearing the 8, 21, and 50-day moving averages. That's a power three break higher at that 150 resistance level right now. So this is coming back onto our major watch list. VRT provides cooling for data centers. Also up nicely today, up 4%, but still below the 50 and the 21 as it tries to put in a bottom of the base there. Let's take a look at what we're holding. First, what we got stopped out on, Tesla. And you can see it closed right on the 400 level after Tuesday. We were down to less than a quarter position because of our stops taking us out of these various levels. And then today was the last hurrah. We gave that up. I think we booked 14% on the last piece. Here's what we own. They're signified by the green flag here, Astera Labs. You're going to see something very common here. You're going to see closes in normally the top 25% of the range for most of these and a bounce at a key level. In this case, A Lab broke below the 21 early, rallied strongly. This is one of the strongest stocks in the market. If you find anything that looks like this, it should be at the top of your watch list. Reddit weak early, gathered strength as the day went along, undercut and reclaimed the 21-day moving average. Palantir, this is one that was on the weak side today and stayed red, but it did undercut and reclaim the 21-day. Bros, the strongest stock in the portfolio and one of the strongest in the market today, too. Above average volume, up 7.5%, made a new high. Looking great, relative strength confirming it. So that puts this the number one stock in the portfolio. And we've got a quarter size position in this. It's not overly liquid, so we don't go too heavy on it, but we will be looking to add to that if the strength continues. Rubric, undercut and reclaim the 21-day. Google bounced at the 21-day. Broadcom closed right below the 8-day moving average. So a little bit of a change in character there. The 8 had been providing support. Still one of the strongest stocks in the market, but after two monster up days after its earnings report, it's just going sideways, bucking the overall down trend of the market. EQT, one of the oil stocks that we got into earlier this week, making a higher high, up 2.7%. The polar vortex is providing a need for energy to keep everybody warm. And here's Antero Resources AR, another oil and gas stock that we own, holding the breakout of this nice cup and handle up 1.5% today. That's all that we own. Let's see what was bad in the 21 over 21 today. There were a couple I already mentioned. Tesla. Whoops. And here we go. So breakdown today in SoFi. Didn't really see any news on it. It had been hanging around the 21, but down on big volume today. This will most likely come off the list this weekend. I could take it off right now because it's actually below the 50-day. We'll just leave it on there until the week closes. There's Tesla. We talked about that. And Teva, which is a generic drug company, but getting into some unique drugs that they're developing. Recently had a good result in one of the phases of the major drug that has a potential big target market, but it's pulled back 3 days in a row now and down 3.36%. RKLB, we mentioned that down. We own that as well. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855 Real Wealth. That's 855 732 5932. This weekend, clients, I will be sending out the year-end review video, so be on the lookout for that. If you're interested in becoming a client, we have people especially excited about the TurboTection portfolio that Ted and Connor are going to run. It follows GROTECTION rules, but the rules have been tweaked to allow them to take some bigger position sizes than we normally do, and also to lower the daily dollar volume. This means more volatility, more potential upside, but also more volatility. But if you're an accredited investor or have a portfolio and you've got decades to retirement, this just might be the portfolio for you. So give us a shout and we'll discuss it with you. The phone is 855 Real Wealth. That's 855 732 5932, our flagship portfolio named GROTECTION. Well, all the portfolios that we have, they've got a dual mandate, and that is participate in the upside. When things start to come off, we lighten up. If you turn into a full bear market like 2022, we just get the heck out of the way. The key level is this black line here. The market never gets into serious trouble. All bear markets occur below this black line. So applying some simple technical analysis, they say you can't time the markets. We disagree with at Revere. We disagree with that. If anybody ever tells you if you missed the best so and so number of days, they're being disingenuous because they don't talk about what if you missed the so and so terrible days. I should rephrase that. They say if you miss the X number of best days in the market, you far underperform. Well, if you miss the worst days, you will far outperform. And they also don't mention that those best days and terrible days are usually sandwiched next to each other because volatility picks up and they normally happen during bear markets, but we'll be out of the way of those because we respect price and we especially respect the 200-day moving average. That's going to wrap it for Thursday, January 2nd. This is Don Vandenbord with Revere Asset Management telling it like it is. Thanks for listening and have a great day.